I'm Alan Kenny, Editorial Director with REIT.com, and we're at REITWorld 2014, NAREIT's annual convention for all things REIT. Joining me is Paul Curbo, Portfolio Manager with INVESCO Real Estate. So, Paul, you've been in the business now for over 20 years. What's been the biggest change in the real estate market in that time?
Real estate has become an accepted investment class. I think 20 years ago, we were often having to explain the merits of investing in real estate. And I think the 20-year period has really shown those benefits. So income, diversification, total return, those have really been proven up over the past 20 years. So as a result, real estate has a much better cost of capital. Both private and public, debt and equity, they've all come much lower in terms of spreads or cap rates. That's the positive side. A little bit of the counterpoint to that would be that real estate now is more affected by the capital markets than it was 20 years ago.
And you recently wrote about some of the difficulties that REITs are facing in the acquisitions market. Give us an idea, what's going on there?
So 2 or 3 years ago, REITs had a cost of capital advantage. They were able to buy assets, and that would be accretive to earnings and over time accretive to their net asset value. Today, that's more difficult for the REITs to undertake. They really can't make large acquisitions that are really going to be incremental to their earnings. So as a result, they really need to focus on other things besides just acquisitions until it's a time where they're trading at a premium once again.
So in light of that light acquisitions activity, what does that mean for where you're focusing your investment dollars?
So I think the opportunity is that if there are fewer acquisitions, there's probably actually less room in terms of internal growth to grow occupancies as well. I think the opportunity is for REITs to focus on redevelopment and development capabilities. Fortunately, there are several REITs that are really good at that. They've been able to manage the risk, been able to grow asset value over time. Acquisitions today in the marketplace are trading at a premium to the replacement cost. So a REIT that can deliver a project at replacement cost is creating earnings growth and creating net asset value growth over time. I think the other thing that we need to consider is risk and whether the REITs can adequately finance those projects. So do they have the balance sheet capacity in order to undertake new development? So we like companies with substantial free cash flow generation, that have good balance sheets, that have development projects that are already underway and delivering. We think that that's something that is a little bit undervalued by the market today and a source of growth over the long term.
Paul, thank you so much for your time. And for more information on this and other REIT news and analysis, be sure to visit REIT.com.